Welcome back to ZenOptions. In today's video, we're going to break down one of the simplest and most reliable option strategies for retail traders, the credit spread. It's a structured, probability-driven setup that doesn't require constant guessing of market direction. We'll walk through how it works, how to pick the right strikes using delta and DTE, and then I'll show you how ZenOptions automates the entire workflow to surface high-quality opportunities quickly and easily. Let's get started. A credit spread is a simple, defined risk option strategy made up of two legs. You sell an out-of-the-money option to collect premium, and you buy another option even further out of the money as protection to limit your risk. Hence, it's a defined risk strategy when your maximum loss is capped. The credit, or premium you receive for selling this option, is your defined maximum profit. Credit spreads work especially well for retail traders because they benefit from time decay, and they follow a mechanical, probability-based approach, not speculation or guessing. And we can use a credit spread in a bearish or bullish situation with a call spread or a put spread. Let's look at a simple example. Suppose SPY is trading at 683. If I think price may stay below a certain level or move slightly lower, I can put on a bearish call credit spread. I sell a call at 700 and buy a call at 710. If SPY stays below the short strike, the spread profits. If price moves up and breaks that short strike, we enter a loss zone. And if it continues to the long strike, that's the defined max loss, but it cannot go beyond that. On the bullish side, a put spread works the same way in the opposite direction. Still using SPY at 683, I sell the 670 put and buy the 660 put. If SPY stays above the short put, the spread profits. If price falls into the strikes, the trade enters the loss zone. Below the long strike is the max loss area. These three scenarios, profit, loss, and max loss, are always known in advance and helps us manage our positions better. To set up a credit spread properly, there are four key decisions. Number 1. The underlying ticker. Pick something liquid and stable and decide whether you want a bullish or bearish bias. Some of my favorite tickers are SPY, Meta, JPM, Microsoft, Nvidia, to name a few. Next is the expiry, or DTE. I stick close to 45 days to expiration and manage my position till 21 DTE. This gives the spread enough time to work, theta decay is smooth, and managing the trade becomes very predictable. There are lots of research done on why this is one of the highest probable win rate, as the realized move is smaller than the expected move. Third, choosing the strikes, and this is the most important part. I use delta to determine how far out my short strike should be. A typical range is around 25 to 30 delta, which balances probability and premium well. I also want to make sure the strike sits safely outside support and resistance for higher chance that the price do not break my short strike. Number 4. Width and premium. Most of my spreads are $5 or $10 wide, and the premium must make sense for the amount of risk I'm taking. I like a risk-reward where I'm risking less than $3 for every $1 of premium. Credit spreads are consistent, high probability, and easy to manage when done systematically. But doing all this takes time and is very manual, and it's easy to miss good opportunities. Here's where ZenOptions really changes the experience. Everything we just covered, checking support and resistance, evaluating momentum, finding the right DTE, scanning deltas, testing widths, calculating risk-reward. ZenOptions does all of this automatically. Let me walk you through the exact workflow I follow every day to keep my trading systematic and disciplined. Once you add your tickers, ZenOptions updates technical levels, support, resistance, RSI momentum every single day. Then the ZenScan engine takes over. We can even look at the scan logs to see exactly what it's doing in the background. It analyzes whether conditions are leaning bullish or bearish and decides whether to search for a put spread or a call spread. If the right signal is found, ZenScan dives into the options chain around your preferred expiry.
I usually use 45 days, and begins evaluating spread candidates. It also checks open interest to make sure the trade is actually tradable. For every potential setup, it checks whether the short strike sits safely outside support and resistance, whether the delta is within your preferred probability range, whether the width matches your settings, whether the premium is fair, and whether the risk-reward aligns with your criteria. It does this leg by leg, spread by spread, and scores each one objectively. ZenOptions also explains why a spread qualifies, in clear, simple-to-understand English. At the end of each scan, it gives you the best candidate, with the exact strikes, expiry, width, and pump fee you need to place the trade in your broker. It's simple, it's transparent, and it removes the guesswork that slows down retail traders. And the best part? ZenScan performs this entire workflow across every ticker in your watch list. So instead of manually checking ticker by ticker late at night or during the day, you get a clean list of high-quality candidates generated automatically. This isn't about predicting the market. It's about creating a consistent, probability-based workflow that saves time and improves decision-making. If you'd like to try this yourself, you can join ZenOptions for free. Add your tickers, run a scan, and start seeing clean credit spread opportunities without the manual work. Thanks for watching, and I'll see you in the next video.